Hi, this is Phil Chandler. One of the unique aspects of real estate investments, such as apartments, as compared to other investments, such as what you might have in stocks and bonds, is having the ability to depreciate the property each year on your tax return. The depreciation is treated as an expense to you as the investor, even though there is no actual cash required. This is an expense on paper only. So, your taxable income that you report to the IRS has been reduced, and we call that a benefit because it shelters some of your income. So with an apartment property, the IRS allows us to depreciate the purchase price you paid for the building over a 27.5-year period. Now, the only thing that cannot be depreciated is the value of the land itself below the building, since land is seen as not a depreciable asset. Dirt is always going to be dirt. So depreciation helps us to improve how much cash we get to keep, and that is good. And with a little more work in using a technique called cost segregation, we're actually able to increase the rate we can depreciate an apartment, which allows us to shelter even more of our income each year. And that is certainly a good thing. Cost segregation is a powerful tool to increase your cash that surprisingly many commercial property owners either do not know about or simply do not think it's worth the effort. But let me explain how it helps. So, initially when you purchase an apartment, it's going to be split into two main cost components, the land value and everything else. And that all goes to the real property value, which is the component that's depreciated over 27.5 years. Let's say you buy an apartment building for $1 million, and we will assume that 20% of the purchase price will go towards the land cost, which means we can depreciate 80% or $800,000 of the purchase price. So without cost segregation techniques, you can use a depreciation expense of around $29,000 each year, which comes from taking $800,000 divided by 27.5 years. So using a guesstimate of a person's marginal tax bracket, let's say 25%, means you get to keep around $7,200 each year in taxes, which is perfectly acceptable. That's good. But through cost segregation, we can make an analysis and determine that of the $800,000 in building costs, we can categorize, let's say 15% as personal property items such as carpet, cabinets, shelving, specialty lighting, and millwork, and some other items. But let's assume that those are all valued at $120,000. Now we can depreciate those over a 7-year period, which provides $17,142 in depreciation each year. And a further cost segregation recategorizes another 15% as land improvements such as asphalt parking lots, sidewalks, parking lot lighting, and storm drainage, which would be valued at, in this case, $120,000, and that can be depreciated over 15 years, which provides $8,000 in depreciation each year. So then, of course, the remaining building cost is still depreciated over 27.5 years. Okay, all this provides $20,000 in depreciation each year. So the new yearly depreciation is $45,505 instead of the standard amount of $29,000. You now have increased the amount of cash you get to keep from tax savings from $7,200 to $11,300 each year. And for those that like to analyze numbers like I do, that's a 56% increase. Now every property is different, but the example provides a reasonable range of the kind of savings you can see with cost segregation. Knowledge is power, and investing in apartments, in my opinion, provides a great place to diversify everyone's investment portfolio.